The return of market turbulence has emotions running high. We're going to talk about how to sort through the rhetoric, as well as create a mindset that can get you through these difficult times. So it's been an interesting week for sure. Market emotions are running high, along with market volatility. Hyperbole from the pundits, the newspapers, the press is getting back to panic type levels. And while we've fortunate to have talked to a lot of people who are keeping their cool and or seeing this as an opportunity to get some money to work cheaper than they could have a week or two ago, I'm sure there's plenty of people out there that are experiencing a lot of angst that, again, it's just the normal reaction that people have. We've talked about it's literally the same part of your brain that's triggered with mortal danger gets triggered with losing money. Acting on it is where the problem comes in. When moments like this happen, something I have to remind myself as an investor, and certainly want to remind clients, is just keeping a proper framework. And one of the first things you need to keep in mind is that there is a cost to being an investor. This was never going to be an easy road. It was never going to come without difficulty. And what are those costs? Well, one of the biggest costs, perhaps the biggest, is dealing with uncertainty. And dealing with uncertainty around something, i.e. our money, that's how we take care of ourselves and those we love. The reality is you can't do anything about it. And that anybody who's telling you that they've got that roadmap of what's going to come next and they can tell you the future is someone you need to avoid, quite frankly. What you do need to engage in after you accept that understanding is patience, giving things time, and putting your time and attention on your plan. Are you really invested in a way that is going to help you get through a difficult patch, whether that's in your own life or whether in the markets? And it's at times like this that it's a good time to reevaluate one's risk. Everybody, as I say, has a super high gains tolerance. We all love to participate in all the upside. The problem is rarely do we have a commensurate risk tolerance for all the downside that's coupled and the volatility that's coupled with that. But again, a solid plan can help you get most of those long-term averages that you need without necessarily experiencing the full brunt of volatility that taking too much risk can bring. I'm going to keep pounding the drum on this because I see people continue to fall prey. They won't admit that they're trying to market time, but in effect they are. They're trying to they themselves guess what's going to come. And most of the time, it's nothing more than a short-term extrapolation of what's just been. So if markets have been really great, or this stock has been really great, or this asset class is really great, they just assume that'll continue into the future, and that can lead them to taking too much risk. Similarly, during weeks like this where you have a few bad days, you'll hear people say something to the effect of, if this continues forever, I'll lose all my money. Yet to see that happen. Usually things don't go on indefinitely, but again, when emotions take over, those are the types of internal dialogues that we have. So really, what's the value an advisor can bring at times like this? Well, if you looked around, and I'm sure many of you experienced, it seems like many advisors think their primary role is to engage in prognostication, to tell you maybe what you want to hear, tell you that they think they know what's coming, or maybe just to spit out platitudes like, hey, stay invested, you're a long-term investor, etc. None of that's actually helpful for dealing with the emotions and giving you the type of clarity you need like this. What is a great plan, and again, having that correct mindset that understands that, risk and temporary disappointment of the markets, timing not matching up with the timing we were hoping for is an inevitable part of being an investor. Trying to avoid the mania between the fear of missing out on gains and then the fear of losing and jumping back and forth based again on whatever the market's done most recently is critical. Risk is part of being any type of investor. It's unavoidable. If you put everything you have in cash, that might feel like you're not taking any risk. The reality is you're losing 3% a year most of the time due to inflation. And so if anything, you've locked in perpetual losses. If you take too much risk in terms of equity exposure, of course, you run the risk of losses there, or getting to a point in terms of your own risk tolerance where you just can't handle it and sell things after big losses. Even diversified investors have got risks. And most of that is coming back to that risk of missing out. We see this as a big one right now with many asset classes, whether it's international stocks or parts of the fixed income market not working. Being diversified means, by definition, that not everything that you're invested in is going to act the same way and under the same market conditions. And that's the beauty of it over time. But certainly it can be ugly at a moment in time. So again, wherever you're at, from cash on one hand to all equities on the other, to being diversified in the middle, there's still a price to be paid. There's still a risk to be taken. And understanding those, again, hopefully can get you to the right place for you. So in terms of the value an advisor can bring, what are those mindsets? What are those general plans? And really, how can one be thinking about a time like this? Well, if you're on the I need my assets to provide for me part of the continuum, whether you're nearing retirement or in retirement, you need to build a plan, again, that can create free cash flow independent of additional capital appreciation that matches up with your needs. If it is, that affords you that ability to get through these times, not being reliant on the market giving you a certain type of return to fund your needs. And with that, take a lot of comfort, number one, for today, but also number two, confidence in the sense that you're not gonna have to sell anything off at one of these inopportune times when the market's down to provide for your needs, thus giving that share of whatever it is that you own a chance to go back up in value. And so that's, again, key. If you're not maybe quite to retirement, or you're not quite to that distribution phase, this is actually mathematically a good thing for you, in the sense that if you've built your plan, as you should have by now, to have that cash flow coming, it's picking up more shares than you would have picked up if the market was up. That's going to in turn pay you more income. And so if you look at this future date, whether it's retirement or whatever else creates the distribution, you're actually going to have a greater income stream at that moment in time than you would have had the market been up 10%. Counterintuitive, I know it's more fun to see that statement balance go up, but it's true. And again, something that can, at least for these difficult times, give you some confidence until, of course, what we all hope to see happen, markets continue to move higher. For those in more of the capital appreciation mode, again, you should only be there if A, you've got a lot of time to stay invested, or B, you're still investing money. And if that's the case, again, you don't want everything to be at the highest possible dollar value. And these sell-offs, these momentary setbacks in the markets that, again, are an inevitable part of being an investor, are an opportunity to get more money to work, pick up more shares than you would have been able to pick up had the market just gone up in a straight line. And so again, while we certainly all plan on building wealth over time because of the market's ability and the economy's ability to grow, these setbacks, again, frustrating as they may be, don't have to be fatal. Well, there's a reason for hope at this time. Lots of reasons to be afraid. Again, most of those, and if you click in a link below in the commentary, we talked about this on June 22nd. Most of the reasons people give, even with the benefit of hindsight, aren't actually what's moving markets. But are there some things that are out there that have been clouds that people have been using as excuses that might abate? And to me, there's really kind of two things that I would keep in mind at this time if you're an investor. One is on the geopolitical front. That has dominated the headlines this year, whether it's trade wars, whether it's Brexit, whether it's Italy, whether it's Turkey. And the reality is there's actually some good news on that front. Obviously, new trade deals with Canada, new trade deals with Mexico. Looks like we're going to have one with Japan soon, one with Europe. Talks are set to resume next month with China. The U.S. has agreed not to label them a currency manipulator. So again, there's some reason to be optimistic that that trade side could abate here soon in terms of the worries and concerns. Really good news coming out of the Brexit negotiations from both sides, both the UK and the EU, that they think that they might actually be coming close to a deal. And then the pastor was released in Turkey today. Hopefully that'll lead to some improved relations between the US and Turkey. So again, going back to, hey, it's bad, it's only going to get worse type of logic, one of those fallacies that we all can engage in on a subconscious level. There's actually appears to be some real good reasons, again, for hopes and breakthroughs on the geopolitical front. Long-term, what moves markets? Earnings, corporate growth. On that front, analysts are still expecting 20% earnings growth this year, 10% earnings growth next year. If you saw those two twin things, geopolitical tensions easing and corporate earnings coming in anywhere near those levels, again, we're going to look back on this as we have many other times and realize that maybe was not anything to be afraid of at all. That being said, planning or predicting any of these things should not be what your plan's built around. Go back, take that breath, invest, engage in that mindset that this was always going to be part of the struggle, and then double check to make sure that you have a plan that reflects where you're at and where you want to get to. With that, we're always here for you. If you're here in Spokane, we hope to see you next week at our quarterly event. Thanks as always for joining.